Good morning, good afternoon, and good evening, folks. If you guys can hear me loud and clear, and if you can also see my screen, please do give me a sound and a screen check by saying yes. Thank you, Leonard, and thank you to everyone else, and of course, Amrita, for you. Glad to see you over here as well. My name is Naeem Azam, and a bit of a more introduction will be coming shortly. I want to welcome everyone to this particular webinar series, masterclass series. In today's special episode, we'll be talking about the US non-farm payroll data, which is a bit of a, we'll be covering like what we kind of discussed last week, but remember we had some technical issues, so we wanted to do that again, but with a slightly bit more different twist, because obviously every single day is a different day for markets, and especially starting from yesterday evening, what's been happening in the United Kingdom, which is not related to the US non-farm payroll data, but just the general stance in the market and how market players needs to pay attention to them. The political landscape is shifting and drifting in the United Kingdom as Boris Johnson is about to be booted out of number 10 or from his position as a prime minister of the country, as top ministers from his team have started to resign. So far, the count that I have is more than 14 people have actually already resigned, and then that explains the massive drop that we've experienced in terms of the sterling yesterday, because remember yesterday sterling went and broke that 1.19, mainly because of a lot of that strength in the dollar index, because the dollar index was a dominant force which drove the euro dollar towards that below 1.03 price mark, and now the conversation of parity and the euro dollar reaching parity are very, very real. So all what I'm trying to say is that yes, we did this webinar last week and so they had some technical issues, but the landscape from political situation and from uncertainty, the landscape has certainly drifted, and we have more things to factor in as we move forward. And of course, oil prices have shifted lower significantly from that particular price point as well. What does that mean? And then all of that we'll be covering shortly in our webinar. Now, a bit about myself. My name is Naeem Azam, and I work as a chief analyst for AvaTrade. I come with a wealth of 15 years of trading experience. During this time period, I've worked as a hedge fund trader for Bank of New York Mellon and with Bank of America. Many of you may have seen me as a regular guest on CNBC and Bloomberg Television. Here are the handles for AvaTrade's social media, such as Telegram, Twitter, and YouTube. As always, the recording of this particular webinar will also be available on our YouTube channel. So I do recommend you guys to go and watch that if you are unclear about anything in this webinar. Now, some of the housekeeping I wanted to discuss. AvaTrade's a unique technology before that, which is called AvaProtect. It's a revolutionary one-click risk management tool available on AvaTrade Web Trader and AvaTrade Go app. With AvaProtect, you can purchase protection against loss for a defined period after opening a position. If the protection ends and you have an open position that is losing, AvaTrade will reimburse the loss directly into the trading account. The only cost will be the AvaProtect fee itself. Risk warnings, as always, nothing can be perceived as an advice, and the full risk disclaimer is right in front of you. Now, I hope you guys are ready, and then you guys have already downloaded the platform, and if you haven't, I do recommend you to do that. So what's the agenda? Here are some of the study questions, and I want Leonard, Amrita, and everyone else who are regular in our these ones to go through them. We're not going to spend too much time. We're going to go through these particular things pretty quickly, but we'll be discussing some more pressing issues. So the quicker that you guys will reply, the more quicker I can and swiftly I can move. But obviously I have to keep in mind of everyone else who is joining this for the first time, and then just give them a little bit more background. The importance of the US non-farm payroll data. What is the importance? Why is this data so important? What is actually this reading called US non-farm payroll reading or economic data? Can anyone help me with that study questions? Any suggestions? Indicators of economic strength, and Fed uses it for monetary policy. Right on the money, Amrita correctly mentioned. This is the most important economic number or economic data set that the Federal Reserve pay attention to. Their monetary policy, hawkish or dovish, very much depends on the economic numbers, and then this particular number sits on top of the ladder than anything else. Hence, traders need to pay attention, very, very close attention to this particular data. When this data comes out, this number comes out on the first Friday of every month. So 99% of the time, this data comes on the first Friday of every month, and it comes at 12:30 GMT or 13:30, in other words, 1:30 p.m. London time. The moment this data will come, you will see the markets moving all over the place. What assets are going to be moving on the back of that? Which directions they are likely to be moving on the back of that? We will discuss everything in a bit. But right now, the most important thing is that the US non-farm payroll data is the most important economic reading. Traders need to pay attention to this number, and it influences the Federal Reserve's policy decision. Now, the second study question, fairly quickly again, what makes a US NFP reading? Leonard, your question is more, you should direct that question. It's a very valid question to your account managers. They will be able to give you a little bit more information on that. Now, the second question is the study questions over here is what makes a US NFP reading? There are a number of ingredients which can be which very much give indications that how the US non-farm payroll reading is going to be. Now, those particular numbers are, of course, one of them is called US ADP number, right? So this is US ADP number is about the private employment market. So if the private market is strong, we know that the actual number, the actual employment situation over in the United States, which comes, as I said, on the first Friday of every month, is also more likely to be a stronger reading as well. So if this one is strong, so if this one is strong, then we are likely to see this one strong as well. And if this one is weak, we are likely to see this particular reading to be a slightly bit more weaker as well. So that is the sort of correlation between them. And 90% of the time, it actually sits quite well. Now, some of the other important ingredient numbers which we also need to pay attention to at the same time with respect to the US NFP reading is the ISM manufacturing data. ISM manufacturing, because if the manufacturing in the United States is pretty strong, if this number comes in very strong, again, all of these numbers, they come before this particular number. So we know that, okay, that the US NFP reading is really going to be pretty strong as well. And remember the spillover impact of these particular readings, they are quite important as well. Now, speaking of important things, can someone help me to address my question, which is that is there an important economic event that is taking place today? Anyone can answer that question. Anyone. It's open to anyone. So yes, the answers are absolutely correct. The most important economic event that is actually taking place today is the FOMC meeting minutes. They are coming at 7 p.m. London time. Now, remember, these particular minutes, which are going to be coming out today, they are coming before the US non-farm payroll data. So over here, the Federal Reserve, which is the central bank in the United States, do not have any information about the latest US jobs market. So whatever is going to be said in here, either the situation is going to be changed or it will change when the US non-farm payroll data will come. But so far at 7 p.m. today, when these minutes will be coming, we will be expecting higher volatility coming into the market. And I want you guys to be mindful of that one, because US NFP, because the Federal Reserve's, the FOMC minutes are very, very important in terms of the market, in terms of how the market is really going to be reacting. Now, moving on to the most and in some more important question, which is that, okay, right, okay, give me a second, let me just change the display. Okay. So here we were. So what instruments? So the third most important question really comes, and then after that we're going to delve into the more fundamental side, and then the real actual markets, trends, and everything. So what instruments can you really trade? Now, Leonard, I want you to come up with that answer, because like Imutha, you've been here for these particular webinars for a long period of time. So tell me, if you can, and Amutha, you also, what instruments can we trade really on the back of the US non-farm payroll data? So Amutha has taken the lead, and Amutha is saying that we can trade indices, and that means that anything such as, you know, S&P 500 index, and of course the US 500, which is known as the US 500 index, the Dow Jones Industrial Average, and you know, so on and so forth, all of them. And in addition to that, you can also trade gold, because gold is a very, very important asset which traders and investors pay a close attention to. And moreover, you can also trade Forex, right? So euro dollar, for example, is also very, very important. Again, we're going to go through all of them in a bit. We're going to be discussing all of that. Now, I wanted to discuss the more important aspect, which is the current state of the market. What is the market really doing? Where are the noise levels in the market? What we should be really paying attention to when it comes to market. Now, there have been three important factors which have very much been driving markets throughout the first half of this year. Number one is, of course, inflation, right, which is sitting at 4-decade high, or at 40 years high in the United States, and of course in the UK as well. The second one is hawkish monetary policy, meaning the central banks around the world, you know, they've been adopted a very, very hawkish monetary policy. They're increasing interest rate aggressively, and that has created a lot of concern among investors and traders. And the third important factor is geopolitical tensions, right? So geopolitical tensions, by that what I mean is a war between Ukraine and Russia, which has brought investors and traders on the edge. And now the big question really for investors is that how that is really going to be moving forward in the second half of this year. Earlier today, we did a podcast discussing all these particular factors as well. So I do recommend you guys to go and then listen to that if whenever you get a chance. Now, the current state in terms of the inflation really is that it's very much linked to oil prices, right? Now, more recently, what we have started to see in terms of oil price, especially yesterday, is the oil prices have started to flirt with $100 price level, right? They are coming from a very, very extreme price levels, because this used to be like 150 or even 130 was the recent ones where prices, Brent oil prices, were more, flirting with or lingering around. But now they have started to hover around that $100 price level right over here. And if oil prices are going to be moving in this particular direction, i.e. moving to the downward direction, obviously this is going to have a direct impact on inflation as well. And then there's going to also have an impact on your disposable income. What do we mean by the disposable income? The disposable income aspect is, let's say if you were filling up your tank for your car, for the fuel, it was costing you $30 before COVID, or especially before the war. Now the price to fill up the same tank is, I can promise you, has more than doubled. So you are talking about between 70 to 75. At least that is the situation in the United Kingdom when it comes to oil prices or filling up the tank. Now, what that has done, this has taken extra 35 pound or $35 or whatever the currency that you are based in out of your pocket. So you have less of that money sitting in your pocket. Now, if oil prices are going to be shifting from 150 to $100, and then we have little chances now. Actually, reality is it seems like that oil prices could actually shift towards $80, and then from there onwards, the predictions are, the Citibank recently said that we could actually see the oil prices by the end of this year moving towards that $65 price mark. Okay. Now, if that curve begins to shift on this side, it's going to have an influence on inflation. If it's going to have influence on inflation, that's going to have an influence on income at the same time as well, because then that means that you'll be shifting back from $75 to back towards that $30. So that means that $35, which are leaving your pocket right now, they'll be coming back into your pocket, so you'll be spending that money in more appropriately. But right now you are forced to spend that kind of money. So overall, inflation has shifted from the more forward-looking factors for inflation, such as oil prices, have started to shift. Yes, inflation isn't going to be going down straight away that quickly, but it should have impact on the more hawkish monetary policy overall in terms of that. Now, this particular factor, the geopolitical factor, last week we were talking about, more members, more countries joining the NATO, and the UK and the US picking up more, geopolitical uncertainties in terms of changing their stance towards China, telling China what the country should and shouldn't do with Hong Kong, or how Taiwan's security is a matter of a concern, for the UK or for the United States, just literally flaring up those tensions and everything else. Now, this particular week, we have not heard anything with respect to that. But in the United Kingdom, of course, things have changed altogether, because now we are looking at a situation where Boris Johnson is highly likely to be booted out of his office, out of the number 10 Downing Street, and new prime minister could be coming in. So that will have a different impact, but obviously that's got nothing to do with that. But overall geopolitical uncertainty is very much going to be feeding in. So what we are looking at for the US non-farm payroll data is the current state of the market, is inflation, and then hawkish monetary policy and geopolitical situation. So these are the situation, and the most important one is with respect to the oil. Now, what is the number? The big question is that what is the number that we are all expecting going into Friday's reading, right? So what is that geopolitical, the US non-farm number that we need to be focused on? Now, everyone is going to be focused on one number primarily. So let me share my screen and clear some of that over here. Okay, so the number that everyone will be very much focused on the US non-farm payroll day, 130, is the 275,000, right? So as long as the number continues to stay in this range of 250 to 275, the job market seems very, very strong, or at least it looks very decent, because then that means your unemployment rate in the United States is staying at 3.6%. So even though we may have a GDP number which is dropping for the last 2 quarters, and that's a lot to do with the inventory than anything else, but the actual recession is not really a recession, and that is going to influence the Federal Reserve's decision. So that is something that you need to pay very, very close attention to. Now we're going to be moving on to the next and then important point of discussion, and that is looking at the state of the market. So what I'm going to do, I'm going to go to AvaTrade's web trader, okay? And I'm going to log on to the AvaTrade's web trader over there, and we're going to look at the number of instruments that are likely to move, okay? So first of all, it is your euro dollar. On the weekly time frame, oh my God, you can see it's actually crossed below that parity. Is literally coming for this one. It's actually already near parity, that 1.01. Wow, that has been, that's absolutely insane. Let me just quickly look at what really happened in the last half an hour. Wow, the prices have started to shift massively. Massive sell-off is really taking place. Now we are at parity with respect to the euro dollar. That means 1 for 1 in terms of the euro dollar. So for $1, you get 1 euro. Give me 1 second there. I just wanted to bring this particular news in front of you, which is the euro dollar drops and falls to 0.5 to 1.0213. So again, that parity is very, very much, was 1.1. Parity is very, very much on the cards for in terms of the euro dollar. Now, how low can it go going into Fridays? Now, will it fall below parity? I think the chances are, if the number comes in strong on Friday, we could see the euro dollar, because we are literally sitting 18 pips above that $1. We could see for the euro dollar losing its parity, going beyond that parity level. And why do we have such fear? We have such fear. These are self-inflicted injuries because of the war, the stance that they took against Russia, and everything within that has really made the recession situation quite weak for the euro. And now we are looking at a situation where recession is highly, highly likely for the eurozone. And inflation is only going to become slightly bit more worse with the currency going this particular low, dropping this particular low. So so inflation situation isn't really going to be that much improving. So going on into Friday, we are going to expect this particular sell-off to take a little bit to become even more worse. But there's something that we wanted to pay attention the most is, of course, are the US stock indices, so the S&P 500 index. Will we see a bottom in terms of the price action? Are we near enough to that bottom in terms of the price action? That is a major question to focus on. Let me get rid of some of these lines because we don't really need them over here. We will quickly delete them from here. Okay, and I will delete that one as well. And of course, let's get rid of. No, we can keep that one, and we can just readjust it. So in terms of the recent lows, when it comes to the S&P 500 index, right, or US 500 index, really what we are talking about is that the low was right over here. Okay, so this was a low. Then prices kind of went back up and then failed to break above these particular price levels. And today we are seeing a lot of negativity creeping back into the market. Yesterday we also saw that, and today, in fact, we are seeing the prices falling below the close of yesterday, and that's what making the prices negative today. So A hawkish monetary policy, a strong number may not be that much of a good news on one side, because traders could think that, okay, if the Federal Reserve is going to take a more hawkish stance, we could see the markets falling. But hear me out. Here is the flip side of that particular situation. The flip side is that if the number comes in strong, the market could actually go up. Why? Because traders will think that the recession isn't likely, because the job market is still quite strong in the United States, okay? And this particular recession reading, the last 2 quarters that we have seen, they do not really matter. So we could see the S&P 500 index continue momentum to the upside. Now, in terms of a resistance, we are focused on the top of these particular consolidation zones. So these are particular your price levels. But for support zone, I'm going to keep my support zone at this green line where it is right now, because I think that it represents an appropriate risk to reward ratio. But keeping in mind in relation to what can really happen there. Now, what about gold? Because gold is quite an important one as well going into the US non-farm payroll data. Now, what's going to happen in relation to gold prices is gold prices are already losing a lot of momentum. Just look at the sell-off that happened yesterday in terms of the gold price, right? You see that big decline. And as I mentioned earlier, it seems like the gold prices have run out of steam. So the path of least resistance for gold prices is more skewed to the downside than anything else. So what we are likely to see is prices shifting towards that 1676 to 1710 sort of a price level. Because currently where the prices are, yes, there is a support zone which is really right over here, is this consolidation area. Let me mark the lines in between that area, and because it is our our support zone, so I'm going to change the color from this to green, and then we'll change this one as well right over here. To do that, just click on the wheel over here, and then you can change the color to green. Let's do that one more time for over here for our next important major support area, because we have 2 support areas. We have a support area number, no, okay, sorry, this, so we have a one support area number 1 over here, which is sitting right between the price action. So I'm just going to do that over here to make it a little bit more prominent. And then after that, we have another support area in terms of the price action as well. And that support area is running right over here. So let's change the color of this one from this to this. So we have 2 areas, number 1, and we have support area zone number 2. Chances are we're not going to find any sort of a support in this area. Price may find a support in around that 1721 to perhaps 1738. I think I like this area more than where the prices are right now. So we're going to shift that area going into Friday. So keep an eye on the 1738 to 1721, and after that 1676 to 1701. These are 2 important support areas in terms of the gold price. On Friday, if the number is really strong, as the dollar is picking up its pace and it is moving fast, we can and we could potentially see further sell-off in gold prices that could push the price into this area and that area. So we discussed 2 things. We discussed S&P 500 index before, and we discussed the gold prices. I'm going to bring the S&P 500 index once again for you guys. So the areas that we are very much focused on in terms of the price action is this area right over here in front of you. So, and then after that, the next area is right over here. And remember, it can go up and down depending how the market would perceive that. But our areas we have already mentioned, this is our support area number 1. After that, support area number 2 is over here. Resistance stays where the prices are right over here. 2 possibilities, once again, if data comes in strong, market could take that, okay, the hawkish monetary policy is coming, more Federal Reserve hikes are coming. and we could see the market moving to the upside. If we see a momentum to the upside, that would be only and only based on the confidence that the recession isn't really likely to happen and Federal Reserve will bring inflation under control. But as for gold prices, it is more of a story of stronger dollar, and the price levels that we are very much focused on is number one is 1721 to 1738, and then 1676 to 1701. That's all the time that we have for today. I recommend you guys, if you have any questions, go over and then watch the webinar on our YouTube channel, which it will be available on very soon. Otherwise, stay safe and speak to you guys soon.